Okay, this presentation is on, I hope I didn't close that. This presentation is on closing entries. Okay, hold on just a minute. Okay, that did it. Okay, closing entries, of course, is in Chapter 4. If you know anybody who works in the business world, you might hear them just grumbling about having to close the books. This is something that companies do usually at the end of the year. Some do it every month, depends on the size of the company. When they say they're closing the books, that means they are closing down temporary accounts in order to get ready to start the new period. So that's what we're going to be talking about, but let me go through the slides one by one. After you prepare the financial statements, you close the books. Because if you close some accounts before you do the financial statements, of course, there'd be nothing on the statement. Okay, see if I can get this to recede. Okay, a little bit bigger for you. And so the second slide is we close temporary accounts, start the new accounting period at 0. Temporary accounts are revenues, expenses, and dividends. Permanent accounts are the assets, liabilities, and stockholders' equity. Now, there's a real easy way to keep these separate. Think about assets. Think about your bank account. Do you think you go down to the bank at the end of the year and say, oh, take my $50,000 because I need to start my books over at 0? Of course not. Same way with liabilities. Do you go to the bank and say, I'm not going to pay you that money I owe you? We have to take the books to 0? Of course not. And of course, you wouldn't give stockholders their money back. So permanent accounts, if you think about it, are logically not closed. So what we're closing is revenue, expenses, and dividends. Now, there are a couple of reasons for closing them. One is to start over the next year with 0 numbers. In this day and age in computers, that really is not as important as it used to be. When statements were done manually, you literally had to start your new set of books with zeros. Now we can divide things into time periods on the computer that wouldn't really be necessary anymore. Probably the more important thing is that if you don't close the books, if you don't actually go in and do a mechanical operation to close the books, people could actually go back into the books and make changes in the old information. Be a great way to create some fraud. So once you have closed the books, nobody can go back and make any entries into revenues, expenses, or dividends. So that's really cuts down on the amount of opportunity for people to go back and make, or even accidentally make entries into a previous period, but more likely to make entries for some fraudulent purpose. Closing entries aren't made until after the financial statements, because again, if you've closed out revenues, expenses, and dividends, you have no income statement, you have no statement of retained earnings, so that wouldn't make any sense. And closing entries are journalized and posted to the general ledger, just like business transactions and adjusting entries are. So you put them in the journal, and then you have to put them in the general ledger of accounts, of course, to take those accounts down to 0. What happens if you don't close the books? I got a little ahead of myself in my lecture. Your financial statements and your books won't agree. And that's what I'm going to show you coming up in the next few slides. And then there's the thing about employees can go back and change transactions. Okay, this is from the first lecture I did for you, and it shows how and you know this by now because you've done financial statements, the revenue and expenses flow to the income statement. Dividends goes to stockholders' equity, of course, and assets and liabilities go down here to the balance sheet. Now it says closing entries must be made to the general ledger to bring those balances into alignment with the financial statements. And here's what I'm talking about. Here's Speedy Repair Shop. I think this comes right out of the book. This is the adjusted trial balance, and you know that that's what we use to prepare financial statements. So you see here where the revenues went over here and the expenses all went up here. We have a net loss of $2,800. And you see the stockholders' equity where we take out the loss, take out the dividends. And once we do all that, you see our stockholders' equity number is $4,000. Keep that in mind. Next page. What's left to go on the balance sheet, of course, is your assets, your liabilities, and your current stockholders' equity. Now let's back up. If you look here, your capital stock on here was $2,000. And you can see down here that the stockholders' equity was retained earnings was 11.3, and now they're taking out the 7,300. So stockholders' equity now is down to it's now $4,000. That's these numbers combined. Well, let's look over here on the next page. Now you see the stockholders' equity is $6,000. Okay, so this is where the number. I'm trying to see if there's an error on this. Okay, stockholders' equity should be $4,000. This should actually be $4,000. I'm trying to figure out what the entry is. Well, I don't know. I copied all of this out of the book. But the point is, if we're showing capital stock here of $6,000 on the balance sheet, we're showing here on the adjusted trial balance, we're showing $2,000. Okay, so because these numbers flow through the statements and ultimately all end up on the balance sheet, if you do these things in the financial statements and you don't go back and adjust the books, then the books and the financial statements are wrong. I'm not sure where this error is I'm seeing in here, so please just ignore that for now. But just know that when you do these financial statements, you're going through this process manually, moving money from net loss from there to here, closing the dividends, and then moving the numbers over here. And this number comes out not being equal to your adjusted trial balance. There is a memory tool for closing entries when you're doing the test and you don't have time to go back and look everything up. Here's how you close the accounts. The order: you close revenues, you close expenses, you close income, which is in an account called income summary, which I'll go over, and you close dividends. Okay, so here's what you do. To close your revenue accounts, which are credits, you have to debit revenues. Well, if you close the revenues out, you have to put them somewhere temporarily. So you put them in an account called income summary. So here we're parking our revenue over here for a minute. Expenses are normally debits, so you credit those, and then you park it in this account called income summary. Here's your expenses. If revenue is more than expenses, you have net income. You have it on the revenue side is higher. Now we have to close this account. If you close this account, income summary is a credit. You debit that, and that increases retained earnings with a credit. So what you've done, here's what we're doing in the financial statements. We're moving revenues and expenses into retained earnings. This is the mechanism for doing that. This is the account that you use to accomplish that income summary. And then, of course, you close out your dividends, which takes a credit. They reduce retained earnings, so you debit retained earnings. Let me show you what would happen in the case of a loss. We move the revenue in, we move the expenses in. If we have more revenue than, if we have more expenses than revenue, we have a loss. I call it negative revenue here because I'm just using these same words. We have more on the revenue, more on the expense side than we do on the revenue, so we've got negative revenue. First two entries are the same: debit revenue, credit expenses. In this case, we have a loss, so we're going to be crediting income summary to close that out. and debiting retained earnings. And of course, debiting retained earnings reduces retained earnings, which is what a loss would do. And then your last entry stays the same. Okay, this one is missing. No, I think that's it. I thought it might be listing losing a chart, but I'm not. Again, there is a mistake in the numbers in the illustration, but the point is that what you're doing in the financial statement process does not get on the books until you physically do the entries, either if it's a loss or if it's a net. You have to physically go through the gyrations of doing these numbers. This I just show you as an illustration, just so that you'll see that you're parking your revenues here, you're parking your expenses, and the net of those two, of course, is net income or net loss. This is the third account that has to be closed. When you close that, it's the same as moving your net income into the statement of retained earnings. Okay, so that's a real brief lesson on closing entries. Once you've done the one problem, and you don't have to understand this totally, just do what they do in the book. Don't beat yourself to death. Just follow what they do. A lot of accounting is mimicry until you learn it. You just copy what someone else has done, and if you do it enough times, then you'll truly understand it. But to get through this, you just need to know how to do those entries. I will tell you on the test, there's terminology on closing entries, and there's some questions on this account right here. So you need to understand what's going on in this account so you can answer some questions on the test. All right, and now I'm going to prepare demonstration problems on financial statements and this, so you can actually see one of these entries done. Thank you, and that is the end of this session.